Let's talk about something that shapes pretty much everything in our world: financial risk. And no, this isn't just for Wall Street traders. It's in your savings account, it's the reason your favorite company exists, and it even decides whether entire countries succeed or fail. So, let's pull back the curtain and see how this whole thing actually works.
So, let me ask you straight up. Are you a risk taker? Now, before you answer, what if I told you that your answer was kind of decided for you a long time ago? That how you feel about risk isn't just a personality trait, but more like a piece of software that was installed when you were a kid.
Just think about it for a second. If you grew up in a house where your parents had steady jobs with a regular paycheck, the vibe was probably all about stability, right? Security. The safe path was the smart path. But if your parents were entrepreneurs, you grew up in a totally different world. You probably saw risk as an opportunity. It was just part of the game. That early programming sets our default settings for our entire financial lives.
Okay, so that personal feeling we all have about risk, it has a direct parallel in the corporate world. But for a giant company, it's not just a feeling, it's a cold, hard, strategic decision.
Yeah, they call it risk appetite. It's a calculated choice that basically asks, how close to the fire are we willing to get to achieve our goals? You can think of it like a volume dial. A company can turn it up or turn it down depending on what they're trying to do, their company culture, and maybe most importantly, what industry they're in.
And believe me, that dial can be set to completely different levels. Take a company like Visa. Their business model is a machine. It's super stable, spits out huge returns with very little risk. So their appetite for more risk can be pretty low. Now compare that to the retail industry. That world is a knife fight. It's got crazy competition, razor-thin margins. To even survive, a retail company has to crank that risk dial way up.
So, for any company, the name of the game is finding this sweet spot. See, companies grow by taking smart risks. That makes their value go up. But if they get too greedy, if they push it too far, the fear of bankruptcy creeps in, and that value can just fall off a cliff. The whole goal is to ride that curve as high as you can without tumbling over the other side.
This whole thing is a constant balancing act. It's a high-wire act. And to do it right, companies have to know exactly what kind of dangers they're dealing with.
Generally speaking, risks fall into two big buckets. First, there's systematic risk. Think of this as the weather. It affects everybody and you can't do a thing about it. Stuff like a global rise in interest rates or a market crash. Then you've got unsystematic risk. This is the stuff that's unique to one company. It's about their decisions, their strategy, their screw-ups. This is the stuff they can actually control.
And these controllable risks, this is where a company's leadership really proves its worth. Or doesn't. We're talking about things like, do you have enough cash to pay your bills? Are you lending money to the right people? Are your day-to-day operations solid? The collapse of Silicon Valley Bank is a brutal, perfect example of this. They completely failed to manage a controllable risk, how rising interest rates would affect their bonds, and they paid the ultimate price for it.
So once a company sees a risk coming, they basically have 4 moves they can make. First, they can just accept it, do nothing, which, by the way, is still a choice. Second, they can avoid it. Just don't do the risky thing in the first place. Third, they can transfer the risk to somebody else, which is literally what insurance is. And finally, they can try to reduce it, by diversifying their business so they don't have all their eggs in one basket.
Now that idea of transferring risk, that opens the door to some of the most powerful and, let's be honest, often controversial tools in all of finance. This is where we get a peek at how Wall Street tries to wrestle those big, uncontrollable market forces into submission.
They often do this with something called a derivative. I know, the word sounds super intimidating, but the basic idea is actually really simple. Imagine you and I make a bet on who's going to win the big game next year. We write that bet down on a napkin. That napkin is now worth something, right? But its value is derived from something else, the outcome of the game. A financial derivative is just a much fancier version of that napkin. It's a contract whose value depends on the future price of something else, like a stock or gold or a currency. And people use these contracts for basically 3 main reasons. The first is hedging. This is all about playing defense. Think of an airline buying a derivative to lock in today's fuel prices, so they're protected if oil gets super expensive later. The second reason is speculation. This is pure offense. It's making a straight-up bet that a price is going to go up or down. And the third is arbitrage. This is a pretty complex game where traders try to spot tiny, split-second price differences for the same thing in different markets to lock in a guaranteed, risk-free profit.
2 of the most common flavors you'll hear about are forwards and futures. A forward is like getting a custom-tailored suit. It's a private, one-of-a-kind deal between 2 people.
A future, on the other hand, is the off-the-rack version. It's a standardized contract that anybody can buy or sell on a public exchange, like the stock market.
And finally, you've got the option. And it's named perfectly because it gives you the option to do something, but not the obligation. A call option gives you the right to buy something at a locked-in price. That's a great move if you think the price is about to go to the moon. A put option is the total opposite. It gives you the right to sell at a locked-in price, which is your safety net if you think the market's about to tank.
All right, so we've gone from our own personal psychology all the way up to corporate strategy. Let's zoom out one last time to the highest possible level and see how these exact same ideas of risk and reward play out on the world stage, the global economy.
Believe it or not, the entire engine of a country's economy, this massive, chaotic, complex system, can actually be understood with one single powerful formula.
And this is it, the master key, gross domestic product, or GDP. It's just the grand total of all the money spent on four things. Consumption, that's regular people like us buying stuff. Investment, that's businesses spending money. Government spending, and net exports. That's it. Every single dollar that changes hands in an economy fits into one of those buckets. It's the ultimate heartbeat of a country.
And governments are constantly trying to manage that heartbeat. They're like pilots in a cockpit, pulling different levers to tweak each part of that equation. They mess with taxes to influence how much we spend, they change interest rates to get businesses to invest more or less, and their currency's exchange rate has a massive effect on how much they sell to other countries. It's just one giant risk balancing act.
But you know, when we talk about all these global economies, it's not just about the exchange rates. It's about what that money can actually buy. And that's a concept called purchasing power parity. It's just a way of cutting through the noise to see the true value of a currency by comparing the cost of the same basket of goods all over the world.
And what's really cool is how economists do this. Forget a complicated basket of goods. The most famous yardstick is the Big Mac index. Seriously. Because McDonald's is almost everywhere, you can just compare the price of a Big Mac and get a really fun, quick snapshot of what money is actually worth. A crazy high price, like in Switzerland, probably means a high cost of living. A really low price, like in Egypt, suggests the opposite. It makes a super complex idea really easy to bite into.
And that brings us all the way back. From our childhood programming to the price of a hamburger on the other side of the planet, we live in a world that is just woven together by risk. We've seen how companies and entire countries are constantly searching for their sweet spot. So the only question left is for you. In this world of connected risks, where's yours?